Let us see the next question. A Limited of UK has imported some chemical worth 3,64,897 United States dollar from one of its US supplier. The amount is payable in 6 months time. The relevant spot rate and the forward rates are as under. Spot exchange rate is given to us 1.5617, 1.5673 dollar per pound, and 6 months forward exchange rate is also given to us 1.5455 slash 1.5609 dollar per pound. Borrowing rate in UK and US as 7% and 6% respectively, and the deposits rates are 5.5% and 4.5% respectively. The currency options are available, under which one option contract is for 12,500 UK pound. The option premium for pound at exercise price of $1.70 per pound is $0.037 for call option and $0.096 for put option for 6 months period. The company has three choices: forward market hedge, money market hedge, and currency option. And we are required to decide that which one is the best for the UK company. Everybody is requested to go through the question, please. Let us have understanding, let's say, how to make calculation of this answer. Dear students, over here we have been provided with the three alternatives. One is forward market hedge, another is money market hedge, and the last is the currency option. First of all, I am focusing on the currency option. So write on heading currency option. Now friends, most importantly, you can see that the question is providing the information about the exercise price. What is the exercise price provided to us? $1.70 per pound. So using this exercise price information, we have to compute that what is the amount of the pound which is required to be sold for purchasing the required dollar. That is the first working note that we need to prepare. So please write down answer along with me. Working note number 1, calculation of amount of pound to be sold for purchasing required dollar. What is the exchange rate? $1.70 per pound. What is the amount of the consideration? 3,64,897 dollar is equal to this amount of pound. So we understand that this is the amount of the pound which is required to be sold. 3,64,897 into 1, that does not make a sense, divided by 1.7. So this is the amount of the pound which is required to be sold. Three six four eight nine seven upon 1.7. So 2,14,645.29 pound. Next will be working note number 2. Calculation of number of contracts. We can see that over here we have been provided with the lot size information. We are required to enter into the transaction for the pound for 12,500 UK pound. So we understand that so the contract and amount. Entering into one contract, it is 12,500 pound is the amount for which the transaction is entered upon. We need to enter into the transaction for 2,14,645.29 pound. It is equal to this number of contracts, 214,645.29 into 1, that does not make a sense, divided by 12,500. So the answer comes to 17.17. So again you can calculate the answer either by using the 17 contracts or by using 18 contracts. So let us use 17 contracts for doing answer. Of course friends, if at all you take 17 contracts or if at all you take 18 contracts, in both the cases the answer will be having some variation. However, the institute suggested answer is very clear. Let's say you can do answer by either of the method. That is what we understand. Now friends, if at all we enter into 17 contracts, then of course there will be some shortfall. So we are required to compute that, say, what will be the shortfall in the payment. And we can see that, say, the forward exchange rate is given to us. So for the uncovered amount, we can easily enter into the forward contract, say, for the purpose of hedging. The institute suggested answer says that, say, for the remaining amount, it is not a significant amount, so you can just enter into the simple forward contract for the purpose of, say, covering up the shortfall of the payment. So over here we will work out the answer in this way. Please write down answer along with me. Working note number 1, calculation of amount to be paid in pound for shortfall in payment. That is very simple to find. So the total amount minus payment through option. Dear students, the total amount which is payable is 3,64,897 minus 17 into 12,500. That comes to 2,12,500 pound. That is what you are going to sell. For every 1 pound you will get $1.70. So that comes to 3,61,250. So 364,897 minus 361,250. So there is a shortfall in the payment of 3,647 US dollar. So this is the shortfall in the payment, and to cover up the shortfall, we will enter into the forward contract. As far as the forward contract is concerned, it is, say, sell of pound and purchase of dollar, because we are required to make payment in the foreign currency. Okay, we have been provided with the forward exchange rate information. The forward exchange rate is provided to us as 1.5455, 1.5609, 1.5455 slash 1.5609. It is dollar per pound. For every 1 pound, you will get less amount of dollar. So 1.5455 dollar per pound is the applicable rate. 1.5455 dollar is equal to 1 pound. So 3647 dollar is equal to this amount of pound. 3647 into 1, that does not make a sense, divided by 1.5455, that is 2359.75. So this is the amount of the pound which is required to be paid in forward contract to cover up the shortfall. That is what we understand. Working out number 2, calculation of premium. I request you to write the amount of the premium in the chat box. Let us have understanding that say how to make the calculation of the premium. Over here, friends, everybody is requested to pay attention. First of all, we understand that over here, the very first thing that you should see is that in which transaction you will enter upon. You will enter into the transaction for sell of pound and purchase of dollar. Why? Because you are a UK company and you are required to make the payment of the dollar currency. The second thing that you have to see is what is that is in which currency the lot size is given. It is provided to us in pound currency. Taking these two things into account, we understand that you are required to purchase right to sell pound. It means purchase put option. That is what we understand. So basically you need to understand over here that you will purchase right to sell pound. So purchasing right to sell means you will purchase put option. That is what we understand. So friends, over here you are purchasing right to sell means this put premium information is relevant. It is $0.096 and language of the question is very clear. The option premium for pound is this amount of dollar. What does it mean? It means that say if at all you purchase right to sell 1 UK pound, then you have to pay premium of $0.096. We understand that say you are purchasing right to sell 12,500 into 17. This is the number of contracts that say you are going, so this is the amount of the pound that you are going to sell. 2,12,500 pound. It is equal to this amount of dollar. 0.096 into 2,12,500 divided by 1. So the answer comes to 20,400 US dollar. Yes, because this time friends you can see that the question is providing to us the amount of the premium in dollar currency, which is again a foreign currency for us. So now you have to enter into the spot transaction. Spot transaction will be conversion of the pound into dollar. You are supposed to purchase $20,500. What is the spot exchange rate? 1.5617 slash 1.5673 dollar per pound. We understand that this is the exchange rate applicable for our transaction. Sell of pound and purchase of dollar, you will get less amount of dollar. So we understand that over here It is dollar pound. $1.5617 is equal to 1 pound. So $20,400 is equal to this amount of pound. So based on this equation, we'll compute the amount of the pound. 20,400 into 1, that does not make a sense, divided by 1.5617. So that comes to 13,062.69. This is the amount of the pound premium which is supposed to be paid. That is what we understand. I request you to write down the answer. First of all, calculation of the premium in dollar currency, then calculation of the premium in pound currency. So this is the calculation of the premium. First of all in dollar currency, and the same working calculation of the premium in pound currency. That is the way we are required to calculate the answer. Please write down answer. Please write down the premium amount in the pound currency also. So with paragraph write down. In order to decide, in order to decide whether to buy call option or to buy put option, comma, we have to take into account transaction. The transaction is sell pound, purchase dollar. Second thing that say you have to take into account is lot size, which is provided to us in pound currency. So we are purchasing right to sell pound. Hence, purchasing put option. So you purchase right to sell, so put option. Further, premium is given in dollar currency. Full stop. Dollar currency is foreign currency for a UK company. Full stop. So enter in spot transaction to buy dollar for paying premium. Full stop. Working note number 3, calculation of total cost. I request you to put your answer that what would be the total cost to the UK company in pound currency. So let us see how to calculate the answer. Column number 1 particulars and column number 2 is answer. The first is very simple, payment in option contract. Write an answer along with me. It is 12,500 into 17. That comes to 2,12,500. Then payment in forward. That is to cover up the shortfall. The payment in the shortfall, that is in forward, is 2359.75. 2359.75. Then payment of premium. Amount of the premium to be paid is 13062.69. And the last is the interest on premium. 13,062.69 into, we understand that since there is a time gap of the 6 months, we are required to consider the interest on the premium. So over here, borrowing rate is provided to us for the UK currency as 7%. So let us assume that we have borrowed for the purpose of making payment of the premium. So 13062.69 into 7% into 1 by 2. So 457.19. And with that, we will make the computation of the total cost. The amount of the total cost is 2,12,500 plus 2359.75 plus 13062.69 plus 457.19. That comes to 2,28,379.63. This is the cost that we will be having in pound currency. That is what we understand. Friends, over here, number of times the students are having a question that, sir, how we will do answer if at all we take 18 contracts. So I'm just showing you the answer for 18 contracts only for understanding purpose. If at all you enter into 18 number of contracts, that is more number of contracts, then instead of shortfall there will be excess. So what will happen? Working note number 1, calculation of excess amount. Converted in pound. That is the first working note that you have to prepare. So it is the amount in option minus consideration. So friends, over here it is 12,500 into 18. So this is the number of contracts into 1.7. So this is the amount that you will be able to arrange through option 3,82,500. And the amount of the consideration is 3,64,897. 3,64,897. So the excess amount is $17,603. This is the amount of the dollar, which you will have extra. Now we'll make the computation of the conversion of this dollar into pound. So conversion of dollar into pound. So to this extent your cost will decline. You can see that the forward exchange rate is given this 5455.5609. Okay. So over here, the conversion of the dollar into pound. So higher amount of the dollar is required to be given for 1 pound. So it is dollar and pound. $1.5609 is equal to 1 pound. So 17,603 is equal to this amount of pound. 17,603 into 1, that does not make a sense, divided by 1.5609. So 11,277.47 pound. This is the amount of the pound that you will receive. The remaining two working notes are very simple, almost the same that we have done. Working note number 2, calculation of the premium. Friends, once again, what happens that say you are required to compute the premium in dollar currency. You purchase right to sell 1 pound, then the amount of the premium is $0.096 because you have to purchase put option. So 12,500 into 18. This is the amount of the pound that say you are going to sell, 2,25,000. And for that, so this is the amount of the premium which is in the dollar currency. So the answer is going to be 2,25,000 into 0.096 divided by 1. So the answer is finally 21,600 United States dollar. This is what's the amount of the premium. Working note number 3, sorry, in that will be spot transaction. Spot transaction will be conversion of the pound into dollar. So sell of pound and purchase of dollar. Spot exchange rate is 1.5617 slash 1.5673 dollar per pound. This is the amount of the pound to be sold for purchasing $21,600. Sell pound, purchase dollar, you will get less amount of dollar. So what will happen, friends? Dollar pound, $1.5617 is equal to 1 pound. So for $21,600, this is the amount of the pound. Okay. So final answer would be like this: 21,600 into 1, that does not make a sense, divided by 1.5617. It comes to 13,831.08 pound. This is the way the amount of the pound to be sold for purchasing the premium will be found. And then the final answer. That is working note number 3. Calculation of total cost. In the total cost, the first is the payment in option. So it is 12,500 into 18. This is the amount which is supposed to be paid, 2,25,000 pound. Next, receipt in forward. So whatever the receipt in forward that you have, to that extent your cost will fall down. So the receipt in forward is 11,277.47. So 11,277.47. So to this extent your cost will fall down. Then premium. Amount of the premium is 13,831.08. Last is interest on premium. 13,831.08 into 7% into 6 divided by 12. 13,831.08 into 7% into 1 by 2. So 484.09. With that, so we compute the total cost. 2,25,000 plus 13,831.08 plus 484.09 minus 11277.47. That comes to 2,28,037.7. This is the amount which is supposed to be paid. That is what we understand. Now we are required to compare the answer that we have found with the forward market hedge and with the money market hedge. Friends, for forward market hedge and money market hedge, we have done number of questions earlier. So for that say, I have provided the ready-made answer to you. That's in case of the forward contract, this is the amount which is supposed to be paid. And in case of the money market hedge, this is the answer, that is the amount which we are required to pay. So write down final answer, decision. Friends, I am showing both the answers. If at all you would have taken 17 contracts and done answer, 18 contracts and done answer. In both the cases, what would be the answer? Let us write down. Forward market hedge. In that case, it is 2,13,000. Sorry, 2,36,103. As far as the money market hedge is concerned, it is 2,36,510. And in case of the option contract, the maximum cost is 228,037.70, and for 17 contracts 228,379.63. So it is 2,28,379.63. That is the way we are supposed to say make the comparison, and we are required to take the decision. Suppose somebody has taken 17 contracts, somebody has taken 18 contracts. In both the cases, coincidentally, the answer is same, option contract. There is a fair possibility that say it may happen, your decision will change. If at all, let us say that the money market hedge has an answer which is falling between those two values. Then in that case, there is a possibility that your answer will change. But don't worry, the institute has given clear answer that you can do answer by, that is a clear statement that you can do answer by either of the method. So the final decision is enter in option contract. This is what we understand. Now one important point that I would like to tell you, that this interest on premium is not calculated by the institute in the providing suggested answer. And I think that it should be considered. We have the rate of interest information. We know that using the spot rate, this amount is calculated. These two amounts are after 6 months. So why interest is not calculated? I don't see any reason, unless the question specifically provides that you ignore time value of money. So I have done answer considering that interest. The institute has provided suggested answer in which interest is not calculated. Just a clarification, my suggestion is clear, we should calculate it. Let us have a final summary of the answer. The first working note is the calculation of the amount of the pound which is supposed to be sold. It is 2,14,645.29. The second working note is the number of contracts which are supposed to be entered upon, because the lot size is 12,500 pound. Number of contracts are 17.17. So we have entered into the lower number of contracts in the first method of doing answer. Taking 18 is absolutely acceptable. The total amount is 3,64,897, and this is the amount paid through option contract. So this is the excess amount of the dollar. In a way that this is the shortfall of the dollar for which the forward contract is taken. for conversion of the pound and purchasing of the dollar. So this is the amount of the pound to be paid after 6 months. In my opinion, so this is the most important working note in which you are required to understand that say see the transaction details, see the lot size, and based on that say you determine that say you are purchasing which kind of option. Amount of the premium is calculated in foreign currency because the premium is provided in foreign currency. Then using the spot transaction, say we are making the payment in domestic currency. Then lastly the calculation of total cost, payment in option, payment in forward, payment of premium, interest on premium. That is the way the total cost is calculated. This is what we understand. And finally we make a comparison of the three alternatives and we are selecting an alternative which is having say the least cost. That is what we understand.